Hey, good morning, everyone. Hope you're all doing well. Happy Monday. Hope you all had an amazing weekend. A little delay here, but let's get right into it. We're starting off the week with close out at all-time highs into Friday's session. Right, we nearly peaked into that 5,000 level on the S&P 500 futures, and right now we're pulling back a decent bit. But I don't think the party's necessarily over, and we'll talk about where things top out and where the party actually ends in these markets. So, with that being said, let's take a look at some of the news because we have some important data about the Fed. Important data about data dependency. Jerome Powell is also coming on the wire, or I think he might have already spoke, but Jerome's going to be on today, or he already talked today. I didn't really look at it. But we had a pretty hot jobs report into last Friday, right, to end out the week last week. 353,000 added in January. Investors tuned into the latest commentary from Jerome Powell, who appeared on 60 Minutes, aired on Sunday. Or sorry, yeah, it was Sunday, not Monday. So last night, the Fed chair was quick to highlight the robust U.S. economy and path towards a soft landing, as well as inflation that has come down sharply over the past year. So central bank watchers had to digest the latest remarks, which much of it echoing comments he had made in the press conference on Wednesday, where the Fed decided to keep the policy rate at 525 bips to 550 bips. And dented expectations that it would cut rates in March, right? The probability of rates being cut in March dropped significantly after, well, I guess over the last few weeks, but they were a little more cemented last Wednesday when we had the first Fed meeting of the year. So inflation, right? How are we going about inflation? Because inflation has been getting pushed down to the downside over the past year or so, getting quote unquote subdued and reeling into a soft landing. But Jerome Powell talked about inflation being dead, and he said, I wouldn't go quite as far as that. We're making good progress, but the job is not done. Restoring price stability means inflation is low and predictable, and people don't have to think about it in their daily lives. So that was one of his concerns about cutting rates too soon in the Wednesday meeting as well. They asked him why not cut rates now, and he said, well, we have a strong economy and feel like we can approach the question of when to begin to reduce interest rates carefully. Growth is going on at a solid pace, and the labor market is strong, 3.7% unemployment, and inflation is coming down. So, right, pretty good answer there. I like the fact that they're not rushing into cutting rates because that could get kind of wonky fast. They also asked him, what is it that you're looking at? And it's not that the data aren't good enough. We just want to see good data along those lines, right? It doesn't need to be better than what we've seen or even as good. It just needs to be good. And so we do expect to see that. And that's why almost every single person on the Federal Reserve Open or the Federal Open Market Committee believes that it would be appropriate for us to reduce rates this year at some point, right? Important factor. What is the danger of moving on too soon, right? That's a good question that a lot of people have been wondering about. Danger of moving too soon is that the job's not quite done yet, and that the really good readings we've had over the last 6 months somehow turn out not to be true of an indicator of where inflation is heading. So that's a good answer from Jerome Powell, because I see this thing as more of a forward-looking aspect where I think the data hasn't necessarily been reflected yet in the markets fully. So that begets the potential danger of an inflation cycle creeping back in if they reduce way too quickly. Then they asked, are you committed to getting all the way to 2% before you cut rates? And he said, no, that's not what we say at all. No, we're committing to returning inflation to 2% over time. I've said that we wouldn't wait to get to 2% to cut. And then they asked, is national debt a danger to the economy in your review? In the long run, the U.S. is on an unsustainable fiscal path, and the U.S. government is on an unsustainable fiscal path. And that just means that debt is growing faster than the economy, so it is unsustainable. I don't think that's at all controversial, and I think that we know that we have to get back to a sustainable fiscal path. Some of the other aspects that they highlighted and talked about, Jerome Powell doesn't expect that the slump in commercial real estate will lead to a banking crisis. Some smaller banks may collapse collapse or have merged with other banks, but he doesn't foresee the CRE market triggering a 2008-like financial crisis. Powell also flagged geopolitical risks as the greatest threat to the economy, as recently identified in Wall Street polls, but said the engagement with the world and American leadership could benefit security and economic arrangements. So, running into this, we also have China, right, that has been making headlines as we reopen the markets here into the, I guess, start of the week, the U.S. session, right? Sunday, a lot of the markets did open, and I think it's going to be interesting to take a look at this. Let's see if we can look at the CSI 300 here. What else do we have? HSI, the futures. Well, let's just look at CSI 300. Oops. So, when we talk about China, China's been down pretty aggressively over the last, long time, right? If we take a look at the last time we had a continuous upward rally, we peaked out at February 2021, and since then we are down pretty drastically, right? From that peak, prices down currently about 45%, and even last year, while other economies and markets have boomed, we've seen that China has continuously been pulling back aggressively. There's no specifics yet disclosed, but Chinese regulators are pledging support for the country's stock market, right? As you can see, it's been bludgeoned and beat up very, very aggressively. The development comes amid a steep sell-off in mainland China stocks. The benchmark CSI 300 notching a fresh 5-week low last week, and the index is down over 6% in January alone, right? A record 6 straight losing month. As macro concerns overshadow any hopes of a significant rescue packages from Beijing. Elsewhere, former President Donald Trump said in an interview over the weekend that he would consider tariffs on imported Chinese goods of more than 60%. And we've seen that this thing is amidst a very large collapse here, while the U.S. market is pretty much flatlining. There was a decent downward swing on the overnight session here on the futures, where we opened up really low on the Chinese names, but they've rebounded since. But it doesn't look very healthy realistically, which could bring some overall global downside pressure in markets. We also have, excuse me, some news today out of, we have earnings this week for sure. What else do we have? I guess we can look at crude oil here quickly. Crude oil, because again, things continue, right? The U.S. has vowed to step up retaliatory strikes against the Houthi rebels and Iran's proxy in the Middle East, even if attacks on ships in the Red Sea continue. Though President Biden confirmed that he is not looking for a wider war, dozens of strikes were leveled against Houthi target in Yemen this weekend, adding that the wave of unilateral American attacks on Iran-linked targets in Syria and Iraq in response to last month's drone attack that killed 3 U.S. soldiers. The tensions in the Red Sea have prompted shipping companies to reroute their vessels around Africa, leading to delays impacting companies across the sectors, including automakers, energy firms, and even retailers. We can see that crude oil slumped a decent bit over the last week. I like this area for another potential long zone. I think this looks like a gift realistically before we start edging back into that mid 80. So I'm going to be looking for some longs on crude and different assets to start this week. Now, as we come into this, right, and we look at the equity market, right, that's the main thing that I do want to take a look at. When I look at this equity market, let's see here. Some questions. Good morning, people. Yeah, Oatmeal, someone did unsub because I mentioned there's going to be a pullback in 2024. So I'll look at the S&P 500 and the NASDAQ here. On Friday, we had a full trading day, right? We may have one of those very soon as well. But on Friday, last Friday, the equity market rallied pretty aggressively. which is what we were looking for. I wanted to see these distributions hold out. We're pulling back as expected because we're under that key 49.80-ish area on the overnight session. And don't get me wrong, right? I'm not looking at this thinking that we're going to start collapsing here and prices are going to start getting destroyed. I think that there's going to be some kind of opportunity today if we can run into that mid-50, 49.55, 49.60 area to look for some potential longs in the S&P 500 market to see if we can get that beginning rally this week before we do experience maybe some pullback in the latter portion of the week. That's what I'm looking for. If we start moving back under that mid-50 on the S&P 500 in today's session, I expect that prices are probably going to turn lower and we're going to start looking to accept distributions to the downside. But there are a lot of supports realistically as we notch lower and lower to springboard prices back up to see if we can get that next expansive move realistically. So I'm not necessarily convinced that we are about to sell off very drastically. Rather than that, I'm more convinced that we can maybe peak another high before sell-offs come, and those sell-offs are going to happen on a how do you call it, a acceptance of distribution blocks lower, I should say, right? There's going to have to be some kind of change in structure realistically to for me to start trying to call a top on this. NASDAQ and tech hasn't necessarily seen all-time highs yet, so I think that there's potential for that to happen before we start slipping on this. So even with the NASDAQ here, this 730 area, a top band of a distribution, holding some kind of resistance. We came into these single prints on the overnight, cleaned up some of this auction. I would like to see realistically 640, 630, pull back, test to see if we can get that next pop to the upside in the NASDAQ, but that requires a little more of a sell in this regard. So that's what I'm going to be looking for to start the session. I'm gonna wait to see if, what's it called, if these sellers can pull it back a little so that better buyers can step in, very similar to what had happened on Friday, but I don't want it to be that drastic of a pullback realistically if we're going to go and hunt some of those highs. So with that being said, let's open up our live trading room here. I hope everyone is excited and ready to see what we got cooking, and I'll see you guys at TRADEPRO Academy, and we'll be back tomorrow and the rest of the week to identify some market potential, right? So yeah, I agree, Obil. If you're not open to any, to any eventuality, you're not flexible. If you're not flexible, good luck. Pretty much, right? If someone's just continuously looking for the bull side of things, I don't know. It could end poorly realistically. That's their business, none of mine. But generally speaking, right, I'm not necessarily saying that, oh, we're going to see a 2008 like crash this year. I'm looking for a deeper pullback realistically before we start running back up into a very strong 2025. Now, whether this pullback is as deep as I think it might be, I could be wrong, but I welcome any pullback to continue up to the upside, right? We'll see how that shapes up, but I don't necessarily think that pullback has started yet or is going to start super soon, realistically. Those are just my thoughts. So let's open up our live trading room here. I'll see you guys tomorrow. Happy trading, and let's get to it.